We start off with the taper tee-up. Jay Powell telling the market to get ready because the Fed is about to cut back on its bond buying binge. The Fed also signaling rate hikes could happen as soon as this year. None of that rattling the markets today. Stocks popping with all three major averages gaining around 1%. So let's get right to it. Steve LIESMAN's got more on the fallout from the Fed. Hi, Steve.
Hey, Melissa. Yeah, the Federal Reserve strongly suggesting it's on the verge of reducing its asset purchases, saying that if the economy continues to progress as expected, a moderation, that is in asset purchases, may soon be warranted. It was just a bit unclear, but it appears as if the Fed is headed for announcing it will reduce the $120 billion in monthly asset purchases in November and start those reductions in December.
While no decisions were made, participants generally view that, so long as the recovery remains on track, a gradual tapering process that concludes around the middle of next year is likely to be appropriate.
So a fresh round of Fed forecasts lowered growth due to the effects of the recent outbreak of COVID and found the committee split on when that first rate hike will come. 9 are forecasting a rate hike next year, that's up from 7, and 9 forecast no hike. Powell also addressed the controversy over trading practices and asset holdings by Fed officials. He said the recent news reports and financial disclosures by Fed officials shows the Fed's code of conduct has to change.
It is now clearly seen as not adequate to the task of really sustaining the public's trust in us. We need to make changes, and we're going to do that as a consequence of this. This will be a thoroughgoing and comprehensive review. We're going to gather all the facts and look at ways to further tighten our rules and standards.
Powell did not say how long it would take for the Fed to make those changes, but he agreed with what we had reported here on CNBC, Fed officials owning the same assets that the Fed was buying, Melissa. They shouldn't be doing that.
Yeah, and he himself owning muni bonds, which the Fed was buying, which you pointed out in your story, Steve. He said that was not right. I thought that was really interesting as well. In terms of the overarching, just sort of the direction of the Fed, within the broader framework of the Fed being overly dovish, though, it seems like there is a hawkish move here in terms of rate expectations, no?
You could say that. I wouldn't disagree with you, Melissa. It's very slight, though. I really think, and I'd be interested in what the traders think about this, that if really what's happening here is there's one instead of no rate hikes in 2022, I don't think Seymour would throw up his hands and start screaming, run for the hills. I don't think that's the way they would work here. Maybe Guy would, I'm not sure. But the idea being that it's 1/4 point rate hike. I think if I was looking for a reason to get nervous, it would be the following scenario. The Fed is reducing, is tapering too late, giving more fuel to inflation, and that it gets to the beginning of next year, it's still in that 4 or 5% range on the CPI and has to end up pulling forward rate hikes even further. If we're going to be where the forecast is right now, I would not consider that a major reason of concern.
And that's sort of what Jamie Dimon hinted at in an interview with CNBC 18 overnight, yeah. Steve. And bingo, because that's exactly where Guy Adami, I think, would fall. Guy.
No, listen, I mean, I can't run anymore, so clearly I'm not going for the hills. But, the concern, listen, there's no question that they've done, in terms of our world, Steve, they've done everything since October of 2018. They've done everything extraordinarily well in telling the market what the market wants to and needs to hear. My concern all along has been there potentially could be a misstep in this, and these are my words, not nobody else's. This corner they seemingly are painting themselves into gets smaller and smaller, and I just see less of an exit strategy available to them. That's been my concern, and will remain my concern.
Guy,
with that said, good for them.
Guy, do you know how a guy can pitch like an almost perfect game, give up one hit, lose the game 1-0, and nobody remembers the game? It wasn't a great game. What you said, I think, is perfect to this thing. If the Fed ends up getting out of this, reducing QE, getting down to zero, gradually raising rates, without a major tantrum in the market, without a major outbreak in inflation, then you're right. It did everything perfect from 2018. But if it ends up with this inflation problem, having to bring forward those interest rates, well, then it got more than maybe one hit. Maybe it was a really bad inning, and it ended up not being the outing that we thought it was.
All right. Even I, who have no knowledge of sports, can understand that analogy. Steve, thank you. It's always great to see you. Steve
Sure.
LIESMAN on top of the story. Steve Grasso, what are your thoughts?
So there are people that, and Guy is one of them, right, that feel that the Fed has waited too long to taper as it is. So there are people in that camp already for the running for the hills. But I guess the bigger question would be, what happens if they start tapering? And they made the distinction between raising rates and tapering. What happens if they start tapering and rates don't go higher? That would be my question for Steve, but you let the guest go, but I'm not asking, it's rhetorical now. What would the market do to that? And I would suggest that the market would sell off, because then there's no one at the switch, and all things are out of the Fed's control. And maybe they are already, but maybe now market participants have to realize that the Fed or no one has control over inflation.
So you're basically saying that you're afraid that the Fed's going to taper and that rates aren't going to respond whatsoever to that change in policy. Tim Seymour.
Yeah,
go ahead.
Yeah.
Finish.
Yeah, so what I'm afraid of is the knee-jerk reaction that rates spike higher off the taper or gradually move higher, and then they just hit a wall at 1.6 in the 10-year. That would be my biggest fear.
Tim?
Well, let's stay with the sports metaphor, and using America's national pastime, baseball, I think is a great place to do it. I think the better metaphor is leaving the pitcher out there one batter too long. The guy that pitches a great game, but it's time to take him out. It's been 2 or 3 meetings where the Fed should have taken a lot of this tapering conversation off the board. In other words, they could have begun this. And so, we're going to talk about FedEx, but when you talk about labor-intensive industries, there's nothing transitory about what's going on in the labor market right now. And so this gets back to where Steve, and Guy, but Steve highlighted where there could be an issue here, which is that inflation is really something that the Fed is unable to control. And again, record job openings, you've got a dynamic here where when you hear about FedEx having these massive labor shortages in certain hubs, and what it's doing to their overall business, it takes you back front and center to a place where I think the Fed, and again, going from 7 Fed presidents to 9 in June into September, who actually think that first hike is in 2022, the delta on that, in other words, the change to me, I think is significant. Not one rate hike in 2022, but a Fed that's feeling some urgency to move faster. And it's all going to be relative to a point where they're going to have to move faster than the market has heard them talk about it before. That's what has me concerned. And again, I think the medium term for the Fed is still very, very unclear as it relates to inflation expectations. So look at the dollar today. That's right here and now what has me concerned for markets and for risk assets, because 93.50 on the dollar. And if you think about a Fed and where we were pre-COVID, pre-massive accommodation, you had a dollar at 96 to 98 or so on the DXY. And I think that will be significant for multiple asset classes if we move quickly there. And again, divergence between central banks. Our Fed may be moving faster than others.
So, Karen, how do you interpret the market reaction to all of this then? I mean, if we should be concerned about a Fed that will have to increase rates at a faster pace than what any of us are anticipating at that point, but there's still a lot of runway between now and then, what do you do? Because we saw the markets go higher today. Is that the right answer?
I'm not sure. I was actually thinking that the knee-jerk reaction would be down. I've often thought of this whole scenario as the market has the Fed hostage, or the other way around, like in a bank, and says, you know what, if nobody makes any sudden moves, we'll all get out of here alive. And I feel like Jay Powell has felt like his job is just telegraph, telegraph, telegraph. Whatever it is, as long as you don't surprise the market and you give them ample time, they'll react okay. So I think that I was surprised with the mid-tapering. I don't know the answer. If someone knows, please tell me about the tapering, the cadence of the tapering. Is that all linear if they begin in, let's say, December and end, 6 months later? I don't know that the every month. That's sort of interest to me. And I think that they were right to sort of pause a little. I think the Delta variant ended up being more dramatic than we thought, and we've seen a little bit of a slowdown. And so I think they've been doing the right thing so far. So I don't know that 22 or 23 for a raise makes any difference right now. We're pretty short-term focused market, so whether it's the end of the 22 or the beginning of 23, I don't think it matters.
So, Guy, we often like to play this game on Fast Money. If I told you in advance what the scenario was going to be for the day in terms of major headlines that could be market drivers, guess what direction the markets would take. Would you have guessed this direction that we saw today?
No. I'm brutally honest, as you know, and the short answer is no, given all the backdrop of what we heard over the last couple of weeks with all the headwinds, and obviously not least of which, and we're going to talk about it, but that announcement out of Federal Express. I mean, I would have thought you add all those things up and we're going to have another significantly lower day, and we did not. It's important to point out we have done this before, but just for the new audience viewers, a taper does not mean they're selling things. I mean, all of that means is they're going slower, right? So the Fed balance sheet will continue to grow, albeit at a slower pace. So, yes, we talk about it, rightly so, but just keep in mind that it just means they're growing this balance sheet and buying less things. So it just things have slowed down a bit. And we'll see. Again, to answer your question, I thought of lower for sure today.
So what is Tim, what's your best guess on the direction of the markets and which sectors you want to be in, given what the Fed has told us today?
Well, I think if we have some inflation and we're concerned about inflation, we want to be in reflationary indices, sectors, and places where I think we have either mid or late cycle cyclicality, which continue to be the places that are, in some cases, suffering from labor pressures, but places where, and supply chain disruptions, frankly, that I think are a lot more temporary. So look, I like industrials, I like transports, I like banks. I've said that, and I've been, on the wrong side of that trade if you think back to July. But I think, again, relative to where we are, and think about where we were earlier in this week, both with the VIX that touched near 30, with an S&P that hit that 5% down trade. So on some level, today's outcome, not terribly surprising if the Fed was at least a concern, and right now they haven't changed gears at all. So again, the parts of the market that you have to like, to me, are the ones that I think are going to be most sensitive to higher inflation and to growth that could even be sideways, just worried about the dollar, just worried about some other things that may counteract that move.